Hello, my name is James Kaufmann, and I'll be explaining rebalancing strategies and techniques. The theory and concept of rebalancing a portfolio are to reduce risk. If someone were to look at the various markets, the Russell 2000 Index, Foreign Index, S&P Global REIT Index, to name a few, these indexes move up and down at different levels, at different rates, and at different times. Some people can view rebalancing as a form of portfolio risk management that can improve your risk-adjusted return over time. Let's imagine, as a hypothetical example, a strategic asset allocation portfolio of 60% stocks and 40% bonds as your target holdings, which would be disclosed in the investment policy statement for you and your portfolio. If you don't rebalance the portfolio, the more volatile asset classes in the portfolio, equities in this example, may tend to move higher and potentially increase your portfolio risk. Hence, the need for periodic rebalancing may be helpful. To illustrate, we can view the following chart as a basic example. During this time period, the return for a leave it alone was lower, but the volatility of the rebalanced portfolio was lower, with the return ending higher. This portfolio here is being rebalanced annually, also known as calendar rebalancing. An investor may sometimes think that they should use stocks only because the return is higher, or not rebalance at all. As a professional working with people over the decades, I can tell you, for example, if a portfolio earns 90% of the return while reducing risk by approximately 30%, this may be an attractive result. Also, people that can see the risk-adjusted return being better, they may be more likely to stick to their goals through bearish periods if the total portfolio volatility has been reduced. When additional asset types are included in a portfolio, commodities or private equities and others, the benefits of rebalancing may potentially be helpful. Now, there are some various methods of rebalancing theories that can include certain trade-offs. Most importantly, the benefits must outweigh the costs, such as transaction costs and taxes. If an investor uses the strategy of rebalancing inside their qualified account, such as an IRA or 401k plan, the tax aspect may not be of any concern. Calendar rebalancing, which is usually once or twice a year, does not involve a great deal of monitoring. There can be times when market gyrations can temporarily cause a portfolio to be out of balance, as in a short 3-month market correction, for example. Hypothetically, this may sometimes adjust itself without any need for additional rebalancing. Some investors will stipulate the use of a percentage point as a threshold for rebalancing. In this basic example, a portfolio of 60% stocks and 40% bonds using a 5% rule as a mark to rebalance, the area of movement for stocks would stay within a 55 to 65% range and 35 to 45% range for bonds. In this case, the portfolio would not be rebalanced until the range is exceeded. Only then would the rebalance occur. Again, this is a hypothetical explanation of this strategy and various methods. Since the strategy must be beneficial and outweigh the transaction costs and taxes, you must be able to see if this would be worth it. Some other considerations are the type of account, whether taxable or tax deferred, as well as the asset types for stocks, both foreign and U.S., bonds, and assets that are illiquid as they involve higher than typical transaction costs. In conclusion, I believe that having and maintaining the proper portfolio structure is needed to achieve successful long-term investing. To improve the risk-adjusted return, investors should stay calm and rebalance their portfolios through the good and bad times. If you would like to discuss rebalancing techniques in more depth, please do not hesitate to contact me. Thanks for watching.